everyone. Welcome to video number 7 on a debit form of a cash spread. Let's just go over disclaimers. So trading securities, options, futures can involve risk and the loss of funds. Options and futures trading is generally considered more complex than stock trading. Securities, options, futures used as examples are used for illustrative purposes only. We are not recommending that you buy or sell these securities, options, futures. Past performance shown in examples may not be indicative of future performance, and of course, no part of this may be copied, recorded, or rebroadcast without any prior written consent. So let's actually go to the website. In a previous session, we actually talked about covered calls. Now remember, covered calls are a two-part strategy where we take a stock strategy and an option strategy combined. So remember, step one, we buy the stock or we already own the stock. And then step two, you quote, rent out your stock by selling a call option. Now remember, we always want to know if we're looking at selling a call option, would we rather sell our stock at a higher price or a lower price? And typically we would rather sell our stock at a higher price. So if we click on the options tab and we go over to the option chain, we looked at our stock that was currently at $18.24, and we said, well, we typically would like to sell our stock at a higher price. So we took a look at the $19 call option with an expiration on the third Friday of May, standard monthly expiration, where we would collect, if we were to sell the $19 call option, we would collect about 55 cents or $55 for one contract. Now, let's break those numbers down to see what that really means. So let's do an example of a covered call strategy where the stock price is at $18.24. Now, keep in mind again that we are already assuming that you bought the stock already, whether it's on the 3 green arrows or support bounce up or resistance breakout entry on an already uptrending stock. And so now we're looking to sell the call option. Now, if we weren't legging in and we were just doing the covered call all at once, then we would be essentially buying the stock at $18.24, and then we would, so let's do that, buy stock at $18.24, and then we would sell a call option. All right, so in this case, we're selling to open the call option, the $19 call at, in this case, we're collecting 55 cents to sell the call option. So remember, anytime you're the seller, you collect premium up front. So what does this really mean? Well, if we buy the stock at $18.24 and we collect 55 cents, what would the rate of return on this be? So rate of return, that would be profit divided by investment. That's how you calculate that. So in this case, our potential profit is 55 cents divided by, let's say we bought the stock right now at $18.24. So we're just doing the covered call at the same time. So that would be, so let's break out our calculator. So that would be 0.55, so 55 cents per share, divided by $18.24 per share. So that would give us about a 3% rate of return. So let's go ahead and write that down, around a 3% rate of return. Now keep in mind that if you're going to do a covered call, remember it's a stock strategy combined with an option strategy, which means one option contract controls 100 shares of stock. So in order to do a covered call, we actually need to own at least 100 shares of stock. So what does that mean in terms of numbers? So if, for instance, we were doing one contract, then that means we would have to own at least 100 shares of stock. So in other words, we own 100 shares of stock. That allows us to sell one contract. If we sell one contract, then we would make 55 cents per share times 100. So that would mean that we would make $55 for this particular covered call. So this is about a 20-day expiration, so about $55 or 3% in about 20 days. So let's say that we're not called out at all. In other words, the stock doesn't go above $19. It stays below $19. So our option our call option expires worthless to zero, and we keep all of the premium, and we also still own the stock. So what would we need we need in our account to own at least 100 shares of stock at $18.24 per share? Well, 100 times $18.24 would be 24 cents would be $1,824. So that's what we would need in our account to be able to buy 100 shares of stock. Let's say that you do 2 contracts, which means you would need to own at least 200 shares. That means that you would make $55 times 2, so that would be $110 that comes into your account by selling 2 contracts, and you would need to be able to have, in order to buy 200 shares, it would be a cost basis of $3,648. Now, if you were doing 5 contracts, now of course you can go out, you can do 1 contract or 2 contracts or 3 contracts or 4 contracts. Let's just say you're doing 5 contracts, which means that you would need to own at least 500 shares of stock, which means that 5 times 55 would be $275. And that means that your cost basis to own at least 500 shares of stock would be, let's see, $9,120. So $9,120. And if you're going to do, let's say, 10 contracts, and of course, you can do as many contracts as you want, depending on good money management, proper position sizing, and your own risk tolerance. So of course, it would be more beneficial for you to start small in the beginning while you are developing your skill and developing a level of proficiency before you start adding on contracts, because of course you don't want to go too big too fast if you haven't developed the skill yet. But once you develop the skill and you develop consistent action that leads to consistent results, then you can start to add on to your position sizing. So 10 contracts, which means that you would have to own at least 1,000 shares of stock. 10 contracts would be $55 times 10. So that means you would bring in $550 by selling the $19 call option. And your cost basis in terms of owning 1,000 shares would be $18,240. All right. So that's what that would look like in terms of a covered call. So you think about all of the stock that you've owned, at least 100 shares all of these years, and you think, wow, I really could have sold a call option on the stock I own every single month and bring in some extra cash flow or additional income or premium on the stock that I was owning anyway. And that additional premium might have covered maybe a bill or two. So it's learning how to maximize your potential growth on stock that you own anyway. Now, some of you might be thinking, well, you know what? I really like that strategy. I like the idea of being able to own stock and then be able to collect some extra premium on that stock if I'm going to own that stock anyway. And then some of you might be saying, well, I really like that concept, but if I have to buy the stock first and I have to own at least 100 shares of stock, that sure can start to take up a fair amount of capital, especially if I want to start to own maybe, let's say, 1,000 shares. That means that my cost basis would be to own 1,000 shares in this scenario would be $18,240. So you might think, well, that could start to get a little bit capital intensive. So what would be an alternative to doing a covered call where you can actually start to utilize your money in a more leveraged way? In other words, as you start to gain knowledge, you then start to develop skill. When you start to develop skill, you actually start to gain a little bit of power in terms of making your money work for you. So this is where we start getting into something that's called a cash spread, and this would be a debit form of a cash spread. Now, a debit form of a cash spread is very similar to a covered call, but instead of step 1, where you buy the stock and then sell the call as step 2. Step 1, you would buy the right to buy the stock, which means you are not actually buying the stock at all. You are just buying the right to buy the stock, which means you are simply buying a call option. So again, similar to a covered call, in a covered call you're buying the stock, step 1, and then you're selling a call option off of the stock that you own. In a debit spread, you are actually, step 1, buying the right to buy the stock, which means you're buying the call option, and then step 2, you're actually renting out that right. So again, in a debit spread, similar to a covered call, instead of step 1 where you're buying the stock and then you're selling a call option off of that stock, in other words, you buy a stock and then you quote rent out that stock by selling a call option and collecting extra premium, in a debit form of a cash spread, you are, step 1, buying the right to buy that stock, not buying the stock, buying the right to buy that stock. And then step 2, you are, quote, renting out that right. And by renting out that right, you actually collect some extra premium when you sell a call option. So this actually will start to allow us to utilize our capital in a way where we don't have to put out as much when we enter the trade. In other words, it can reduce our cost basis very significantly. So how would a debit spread work? Well, it's the same concept as a covered call. In other words, when you buy a stock, you actually want price to go up, correct? So if you're buying the right to buy the stock, you still want the price to go up. So we actually call this type of strategy a bull because we want price to go up. In other words, how do we make money? We make money when price goes up. Call, because we're utilizing calls. Step 1, we're buying a call. Step 2, we are renting out that right by selling a call. So we're utilizing call options. And then spread, because we are spreading out the strikes, or we're doing more than one leg. So that would be a spread, more than one leg. Another name for a bull call spread or a debit spread is what's called a long vertical, so long call, vertical spread. Now, why long? Because the main part of your spread trade is you're buying the call, just like in your covered call. The main part of your covered call is you're buying the stock. So in this case, the main part of your bull call spread is you're buying the call. All right. So remember, long is just a fancy way of saying you're entering a position as a buyer. So long, then call, because you're utilizing calls in this spread trade. So essentially you're buying a call and you're selling a call. Vertical, which means your expiration is going to be the same time frame for both legs. So the same expiration for both legs. That's what vertical means. And then spread, you're doing more than one option, or you're spreading out the strikes. So that's another name that you might hear out there. So bull call spread, long call vertical spread, debit spread, they all mean the same thing. So what is your goal for a bull call spread? Well, your goal is that you want price to go up, but what you really want is you want price to go up so that you're actually called out of your spread trade. So for instance, let's say that you buy the right to buy the stock at $25 and you sell a higher strike. So it's just like a covered call. How do you know which call to sell off of the stock you own? Well, you ask yourself, would I rather sell my stock at a higher price or a lower price? Similarly, in a bull call spread, if you're buying the right to buy the stock, in other words, you're buying the $25 call, then you ask yourself, would I rather sell that right at a higher price or a lower price? And typically you would rather sell it at a higher price. So let's say that you sell the $30 call. Well, what is your goal for this trade? Well, you actually want price to close above your strikes. So close above your spread trade so that you're called out. Once the stock is above your short strike or your spread trade on expiration, you're completely called out of the entire trade, essentially, and you're out of the trade. You're out of the trade, you're left with your profit. You now move on to the next trade. the next potential trade. So that's what your goal is you want price to close above your short call. In other words, you want to be called out on expiration date. The only way you'll be called out on expiration date is if price closes above your short call, and if it closes above your short call, then by default, it'll close above your long call. You'll be out of the trade. You're left with a profit. You move on to the next trade. At the very least, you at least want price to close above your break even. And of course, since this is a bullish strategy, you want the stock to continue higher from where you entered. So the ideal scenario, so again, if we bought the $25 call, buy the $25 call, and we sell the $30 call, and let's say we sell the $30 call at $1, then the ideal scenario is the stock closes above 30. If it closes above 30, then someone will exercise their right to buy your stock at $30. You turn around and exercise your right to buy the stock at 25 to then sell it to them at 30. This happens automatically. You collect that $5 plus the premium that you received by selling the call option. Now, is there a chance that if prices is above your short strike, in other words, above your spread trade, is there a chance that you could be assigned on the short side early? Yes, there is a chance that you can be assigned on the short side early. It doesn't mean you have to, and it doesn't even mean that you will be assigned. It just means that theoretically you could be assigned. If you were assigned on the short side, and remember, the only way you would be assigned on the short side is if price is above your short strike. So if you're assigned for some reason, and again, it doesn't mean that it will happen, and oftentimes you are not assigned even if price is above your short strike. But if you were to be assigned on the short strike, no worries at all. You just turn around, you exercise your $25 call to then sell it to them at the $30 call, and you actually lock in your profit prior to expiration. Now you're out of the trade, you can move on to the next trade. So it's not bad if you're assigned early. The secondary scenario, of course, is that you at least want the stock to close above break even on expiration. That would be the next best scenario after the ideal scenario. So why would you do a bull call spread? Well, the very first reason is that it would be less capital required than if you were to do a covered call. Why? Because instead of buying the stock itself, you're just buying the right to buy the stock. When you buy the right to buy the stock, then you're just paying a premium for that right. And then you turn around and you, quote, rent out that right by selling a call option. So it really, really reduces the cost basis on your trade. When we do a bull call spread, we actually prefer to actually utilize in the money call options. Why? Because in the money call options have some intrinsic value, and since they have some intrinsic value to it, then time value is not decaying as quickly against us. So what are in the money call options again? Well, let's say that your stock is at $27. We would prefer, when we structure our bull put spread, is we would prefer to sell and buy in the money call option. So we might sell the $25 call and we might buy the $20 call. Stock stays above your short call, which means it stays above your spread trade, and this is what we want. So if on expiration the stock is at $27, then that means that we will be called out of our position. We then are left with the profit, and we are left with cash, and then we move on to the next trade. The other reason why we might choose to do a bull call spread is, let's say we look at a more expensive stock. Let's say we look at something like Facebook or Apple, and we decide to buy a call option on Facebook or Apple or Google. And we run the numbers, and remember, if we were to buy a call option by itself, then we need price to move up, and we need price to move up fairly significantly. In other words, we need price to move up more than the time value decays on the option. That's the only way we'll actually make money if we buy a call option. Well, for stock like Apple or Google or Facebook, that call option might be more expensive than we would like. So what we could do, a way to reduce the cost basis of just simply buying a call option by itself, is we could buy the call and then collect money by selling a call off of the call that we bought. And that's one way to reduce the capital or the amount required to be able to place that trade. The other thing that would be very advantageous when we do a bull call spread is we can actually define our risk ahead of time. So if we buy a call and then we, step two, sell a call off of the call that we bought, well, now we know how much we could lose, worst case scenario, before we even enter the trade. And this is called defined risk. So in this way, we can really understand our risk ahead of time. And if we understand our risk ahead of time, and that risk is significantly less than if we were to buy stock outright, then this becomes a benefit as well for doing a bull call spread. So what's our checklist for a bull call spread? Well, number one, we want to look for a good quality stock that is uptrending, just like we would if we were to do a covered call. So we want a good quality stock that is uptrending. So we check the chart. We want to make sure our technical analysis supports a potential move up call. So in a covered call, typically we want a time frame when we sell the call off of our stock. We typically want a time frame anywhere between 20 to 40 days out. So same thing with a bull call spread, is we want to pick a time frame anywhere between 20 to 40 days out. It's just that with the bull call spread, because it's a vertical spread, the call that we buy and the call that we sell, we want both of those legs to expire on the same date. Then we place the order, we monitor the trade, and then we close out the trade if necessary. So find a good stock. We can utilize the good stock search, the almost good stock search, the undervalued stock search, very similar to when we look at a covered call. You can also use your own list of candidates if you want to do some sort of bull call spread on stocks that you've been watching anyway. Of course, you might find a stock based on news, but you always want to do your own analysis if you do find a stock based on news. After you find a stock to potentially do a bull call spread on, then you want to make sure that your technical analysis is supporting a potential move up. So an uptrending stock where you might have a support bounce up off of support, or perhaps a resistance breakout. So those are two nice entries for potentially doing a bullish trade. You can certainly leg into your bull call spread. In other words, you can buy the call first and then sell a call, or you can do it as just one trade, which would then make it a spread trade. So we're actually going to discuss it as a spread trade. Again, your expiration date, we're really looking for about 20 to 40 days out. If you go too far out, then you're really starting to be under obligation for perhaps a longer time than you really want to be. So if you place a trade where it's a 6-month expiration, then that's an awful long time away. You might instead choose to do just a bull call spread maybe every single month for 6 months instead of just one trade 6 months out. And again, you want your technical analysis to support your bullish strategy. If you're a little more conservative, then we're going to gravitate toward more in the money call options. If you're a little bit more aggressive, you might actually choose to even structure your trade using some out of the money call options. But if you do that, then you really do need the stock to move. So we're going to start with a more conservative structure and use in the money call options. So let's take a look. So if you do have a stock, let's say at $27, right? Let's say the stock is at $27 up here. All right, you would prefer to structure your trade where you buy an in the money call option, let's say the $20 call, and you sell the 25, another in the money call option. So you sell the $25 call. Remember, the current price of the stock is at 27. And then what do you want? Well, on expiration, you want the stock to be above the strike that you sell, which means it'll automatically be above the strike that you also bought. So above your spread trade. And then that means that you will be called out. In other words, someone will exercise their right to buy your stock at 25. So they will call you out at 25. Because you don't have the stock itself, you turn around, buy the right to buy the stock at 20 to then sell it at 25. You collect that difference in profit plus whatever you collected in premium, and you are left with your net profit, and then you're out of the trade, you move on to the next trade. Now, this will happen automatically. In other words, as soon as someone exercises their right to buy the stock at 25, they will know that in your account you have the right to buy the stock at 20. So then that transaction will happen automatically, and then you're essentially left with the net profit on expiration. So how do you place the bull call spread? So again, the bull call spread is a vertical spread trade, so it's really the same expiration. So this would actually be September. All right, so you would buy the right to buy the stock, so you'd buy the $20 call at the same time. So we're placing both legs on at the same time. So we're placing it as a spread trade. Now, if we place it as a spread trade, that means it will be filled either both legs at the same time or not at all. All right, if we place it as a spread trade. So then you would sell the $25 call at the same time. All right, same expiration date. Buy the call and then sell a higher strike call. So buy to open and sell to open. And then whatever the net debit is, so you're buying more. When you buy the call option, you're paying out more than what you collect when you sell the call option. So that leaves you with a net debit. Now remember, if you do market order, you're basically saying, I'm giving you a blank check, fill me at whatever price, I don't care. If you do a limit order, then you're specifying what you're willing to pay out for this spread trade. All right. In this example, then our limit order or our net debit is $4.35. So essentially, if we do one contract, where essentially our cost basis is $435 to do one contract, and one contract controls 100 shares of stock. So that's how you would actually place the trade. So let's go back to the website and let's take an example of a bull call spread and see what that might look like. So if we're looking at doing a bull call spread, which means all we're doing is instead of buying the stock and then selling a call off of the stock that we own, we're actually buying the right to buy the stock and then selling a call off of that right. So let's say that we look at an in the money call option. So let's take a look. So remember, calls are on the left-hand side. Now, you know what I'm going to do? I'm actually going to see what other options we have. So I'm going over to this section and I'm going to click on all and see if we have more choices here. Let's take a look. All right, so now we have more choices. So I think what we'll do, since the stock is $18.24, I would like both call options to be in the money. So what we'll do is we'll take a look at the $16 call instead. So if we were to buy the $16 call option, so remember, as the buyer, we take a look at the ask price. So the ask price for the $16 call option is currently going for $2.60. So that's $260 for one contract. Now notice that the bid price is actually $2.25. That's quite a wide spread between the bid and the ask. Anytime you have a spread that's more than 10 cents, you may choose to see if you can get a better price for yourself. In other words, essentially negotiate a better price for yourself or a better fill for yourself when you place the order. Oftentimes, Mike likes to say, you know, if you see a bid and an ask spread, perhaps go in the middle between the bid and the ask, and then give the market maker a little bit more. So if we're going in the middle and we give the market maker a little more, which means we would pay out a little bit more than the mid price, then we might see if we can get an order where we can get filled, let's say, at $2.45. So that would give us sort of the mid price, but maybe give the market maker a little bit more. But the $2.45 is definitely a better price for us to pay out than $2.60. So I think I'm going to go ahead and go with $2.45 to buy the $16 call option in this case. So let's go back and let's actually scroll down and let's actually do an example of a bull call spread. All right, so example of bull call spread. Now, stock price is still the same, of course, so this would be $18.24. Strategy is we are doing a bull call spread. Another name for this is a long call vertical spread also a debit spread, which means we are paying out money to do this trade. Position would be, instead of buying the stock, we're buying the right to buy the stock. So we're going to buy to open the $16 call at $2.45. And then what we'd like to do is we would like to sell to open a higher strike. So same, just like in a covered call where we said to ourselves, would we rather sell our stock at a higher price or a lower price? Similarly, in a bull call spread, we ask ourselves, well, would we rather sell that right at a higher price or a lower price? And we definitely would rather sell that right at a higher price. So we're going to look at selling the $17 call at, so let's see what that price is. So the $17 call is currently going for, $17 call is currently going for $1.70. So remember, as the seller, you're looking at the bid price. So buy at the ask, sell at the bid. Notice that the bid is going for $1.70. In other words, we can collect for one contract $170. Now, there's a 10-cent spread here, so you can always see if you can go in the middle, perhaps get $1.75 there. That is absolutely acceptable. Or you can say, you know what, I'm okay with $1.70. So in this case, I'll just stick with $1.70. So let's just type in $1.70. All right. So if we buy the right to buy the stock, then we are paying out $2.45. If we then turn around and sell the right, so in other words, we're renting out our right by selling a higher strike call at $1.70. So we're paying out more than what we collect. So this becomes our net debit, which is actually the same thing as our cost basis, which is actually the same as our potential max loss. In other words, we are defining our risk here where we know even before we enter this trade, we know worst case scenario how much we can potentially lose. So that would be $2.45 minus $1.70. So $2.45 minus $1.70. So that would be 75 cents. So that's our cost basis. So that means that in order to do this particular trade, we would need at least $75 to be able to do one contract. So $75. Now, let's figure out what we can potentially make. If our cost basis is $75, then what is it that we can potentially make? So our potential max profit would be essentially $1. Now, why $1? Well, remember, our goal for the trade is we want to be called out. The only way we'll be called out is if price closes above our spread trade. So remember, we bought the $16 call and we sold a higher strike call. And our goal in order to profit on this trade is we want to be called out. So we want the stock to be anywhere above $17. Let's say that the stock is at $18.60 on expiration. Well, if the stock is at $18.60, then we will be called out at 17. In other words, someone will exercise their right to buy our stock at 17. We turn around and exercise our right to buy the stock at 16 to then sell it to them at 17, which means we would make $1 in profit. Well, remember, to do this trade, we are actually paying out money to be able to enter this trade. Just like when we do a covered call, we pay out money. Just like when we buy a stock, we pay out money to do the trade. This is no different. So we're paying out money. So if our potential profit is $1, but we paid out 75 cents to do this trade, now our potential max profit becomes 1 minus 75 cents, which means it becomes 25 cents or $25 for one contract. So what is that in terms of rate of return? Well, remember, rate of return is profit divided by investment. So profit, our potential profit is 25 cents divided by 75 cents. So let's just break out our calculator. So let's do 0.25 divided by 0.75. That would be a 33% rate of return. So this is a 20-day trade. So So the third Friday of May, that's about 20 days away. So this would be a 33% rate of return. So not too bad, right? So if we're looking at this, let's just break this down in numbers. So if you were to do, so your potential profit, and then let's talk about our cost basis. In other words, what would we need to be able to make that amount of money? So if we're doing one contract, then that means that we are potentially making $25. And our cost basis, actually, let's do it this way. So this is a little more clear. So $25. All right, so one contract means that we can potentially make $25 of profit, which means we would need how much to be able to do this trade? Cost basis of $75. All right, if we're doing two contracts, then that would be 25 times 2, which would be, of course, $50. And then what would our cost basis be? Well, $75 times 2, that would be $150, which means to make $50, we would need $150 for this particular trade. If we were to do 5 contracts, then 5 times 25 would be $125. So that means we would need 75 times 5, that would be $375. If we were to do, let's say, 10 contracts, then that means we have a potential profit. As long as the stock stays above 17, then we would have a potential profit of $250, and that means we would need $750 for our cost basis. So you might say, well, I'm breaking down these numbers. If I were to do one contract, that means I would make $25. Well, you might think, well, $25, that's not very much. That doesn't really excite me. But how many of you have banks where for every $75 that you put in, they give you $25 back? Now remember, we want to build our skill first and develop a level of proficiency. Once you build your skill and develop a level of proficiency, you can start to increase your number of contracts. So let's say you do 5 contracts. Well, you make $125 and your cost basis is less than $400 to make that $125. Now that $125 could pay for a phone bill. Let's say you get into 10 contracts. Now you're making $250 and your cost basis is less than $800. Maybe that $250 will pay for perhaps a phone bill and some groceries. So now what you're doing is you're utilizing your skill to make some money, and that will free up money somewhere else that you're normally using to pay maybe a monthly bill. So this is when you really can start to leverage your money in a more conservative way. Now, why would I say more conservative? Because keep in mind that if you buy the $16 call and you sell the $17 call, currently the stock is at $18.24. So what do you need to make that 33% on expiration? Well, as long as the stock stays above your short strike, meaning your spread trade, as long as the stock stays above 17 on expiration, you will make that 33%. Now remember, this is a bull call spread, which means we actually want price to go up. That would be better, right? Because the further it goes up, the less chance that, or the higher chance that will be called out, which means that the higher chance will actually make that 33%. All right, so the stock is already at $18.24. If the stock continues higher from $18.24, by expiration, we will make that 33%. If the stock basically does nothing and goes nowhere and just stays at $18.24, we will still make that 33%. The stock can even drop down just a little bit. And we will, as long as it stays above 17 by expiration, on expiration, we will make that 33%, which means the stock can go up, which is ideally what we would prefer it to do. The stock can go sideways. The stock can even go down a little bit, and we will still make that 33%. This is called a higher probability trade. Why? Because we have more cushion for price to move and still make that money. If we were just to buy a call option by itself, the stock would have to move up, and it would have to move up significantly, and it would have to move up more than the time value decays. When we do a spread trade or a cash spread or a debit form of a cash spread or a bull call spread, what we're really doing is it's still a directional trade to the upside, but now we're giving ourselves cushion to allow for price to fluctuate within the trend and still make money. So in other words, you don't have to be perfect in the direction. You don't have to be exactly right in the direction. As long as the stock stays above 17, you will make that 33%. So if we actually go back up and we compare, so let's do this. Let's actually take out these spaces. All right, and let's go ahead and scroll down. Let's do this. Actually, let's do this. Change this to 12. Right, so now you can see the comparison. So now you can see the comparison between the covered call, and you can also see the comparison between the bull call spread. All right, so if we compare these two strategies, in the first scenario, we are actually doing a covered call strategy. Now remember, in a covered call, step one, you buy the stock or you already own stock. So you buy the stock or you already own stock. And then step two, you sell a call off of the stock that you own. Now keep in mind, when you buy the stock, you have to own at least 100 shares in order to then sell one contract of the call option. And when you start to increase your position size, you really do need more capital to be able to buy enough shares to then sell enough contracts. So if you buy 1,000 shares, then you need at least $18,240 to be able to then make $550 by selling the 10 contracts and collecting that premium when you sell the call option. So $550, you need a cost basis of $18,240. In the second scenario, we're actually doing a bull call spread. Now, keep in mind that in a bull call spread, we're not owning the stock at all. We're not buying the stock at all. In other words, we don't need to own the stock to be able to do this strategy. So our goal in any strategy is we want to be able to make some profit. In the first scenario on the covered call, in order to be able to make profit, we have to be able to own the stock or buy the stock. In the second scenario with a bull call spread, instead of buying the stock, we're now buying the right to buy the stock, which means we are not buying the stock. We're just buying that right to buy the stock, which means we are buying a call option. And then we, quote, rent out that right by selling a call. Now, because we don't have to buy the stock itself, we don't need to put as much capital out there. So instead of having to have $18,240 to be able to do this covered call trade, if we're going to do 10 contracts, we actually only need $750 to make $250. So what is our goal in terms of doing these trades? Well, remember, our goal, in order to make that $250, if we are doing 10 contracts, and our cost basis to do those 10 contracts is $750, which is quite a bit less than $18,240, correct? So if we're going to do the bull call spread, what is our goal? What do we need to see happen? Well, we need to see the stock close above the call that we sold. So in this case, if we bought the $16 call and we sold the $17 call, as long as the stock stays above 17, then we are going to make that 33%, which means we want to be called out. That is our goal. We want to be out of the trade. And if we can be out of the trade in this scenario, it would be a 20-day trade. If we can be out of the trade in 20 days and make 33% in our 33% on our money invested, then we then collect that cash. We're now no longer in the trade because it's done. 20-day trade, not too bad. We're not looking at buying and holding for the long haul. We're just looking at being able to make some money for the month and perhaps maybe pay a bill for a month. So how many of you have, how often do bills come? Oftentimes bills come monthly. So if we can just specifically do a strategy that will make us money in maybe a shorter term time frame than buy and hold. We collect that money. We don't have to put as much money out in terms of capital. We make a reasonable rate of return. Now we're in cash again. We move on to the next trade, and perhaps we could do another bull call spread the next month out, and perhaps we could do another bull call spread the next month out. And now we can have our money working for us without having to risk as much capital out there. So sometimes a higher rate of return doesn't mean more aggressive. Sometimes a higher rate of return just means more skill. And that's why we're becoming educated, because we want to be able to leverage our skill and our money and our time. Because what does it take to monitor this trade? Well, definitely you want to pay attention to this trade every single day. You want to pay attention to your positions every single day. But how long would it take for you to know that the stock, currently the stock's at $18.24, how long would it take you every single day to check to see if that stock is still above $17? It's probably not going to take you 8 hours a day to just look and see what the market is doing, look and see what your stock is doing, and say, yep, still above 17. And if it continues even higher, then you're saying, you know what? Yep, it's still above 17. So now you're also leveraging your time. So let's go back and let's take a look at what you want to do when you actually monitor this trade. So again, every single day, you look at your position, you want to pay attention. As long as the stock is staying above your strike that you sold, which would automatically mean that it's also staying above the strike that you bought. So as long as it stays above 17, then there's nothing to do. You want to just leave the trade as is because there's nothing to do. If it continues higher from $18.24, that would be perfect. That would be ideal for you. As long as if it does nothing, that's still okay. As long as the stock stays above 17, you're still good. There's nothing to do on the trade. Leave the trade as is. Now, on expiration, if the stock is above 17, then you're automatically assigned on the short call, which means that your long call will kick in, and then both of those will settle, both strikes will settle to then leave you with your net profit. All right, and again, that is what you want to happen on expiration day. Now, if for some reason you're assigned early on the short call, in other words, someone exercises their right to buy your stock at 17 prior to expiration, well, then you can turn around and exercise your right to buy the stock at 16 to then sell it to them at 17, and you would still end up with your net profit on the trade. So it's not, it's absolutely fine if you get assigned early. All right. Now, if for some reason the stock closes below both strikes, so again, you don't want that to happen. You want the stock to close above both strikes because this is a bullish strategy. But if for some reason the stock closes below both strikes on expiration, then you will have the max loss of 75 cents or $75 for one contract. So at this point, we're not going to talk about altering or adjusting in the trade. I just want you to understand what your defined risk is before you even place the trade. So as long as you know, okay, worst case scenario, if the stock actually drops and the trend changes and my stock is at below both strikes on expiration, well, I know what the most I can lose is. And in this case, your maximum potential loss would be that 75 cents or $75 for one contract. So if we go back to the stock, we can see that the stock, of course, has been in an uptrend. Now, before you were looking at stocks without even doing any kind of analysis. So what you've done is you've actually taken the next step where when you now buy stock, you're actually looking at stocks that are hopefully fundamentally sound, but you're also looking at stocks that are actually going up in value, which means you're already starting to maximize your potential growth. And then we took it one step further and we said, well, you know what? If we're going to buy the stock anyway, we could actually have someone pay us a premium to potentially buy that stock at a discounted price from where it's currently at if we were going to buy the stock anyway. That's called selling a put option. That's something we talked about in the last session. But then we take it one step further and we say, well, you know, if we sell a put every single month and all we do is collect that premium and we sell it month after month after month and we don't ever have to buy that stock, and then finally we do buy that stock, then all the months that we had collected premium prior to having to buy the stock, that premium actually helps us to buy the stock at even a further discounted rate. Then, once we own the stock, we can turn around and start to, quote, rent out that stock by collecting premium on that stock. That's called selling a call off of the stock that we own already. So, that would be a covered call strategy. And now, what we've done is we've even taken it a step further where we say, you know what? I don't even have to own the stock. I could actually buy the right to buy the stock and then, quote, rent out that right by selling a call option and significantly reducing my cost basis, which then actually increases my potential rate of return, where I can actually start to not only leverage my money where I don't have as much risk out there, but I can also leverage my skill and leverage my time. And not only that, I'm actually giving myself a higher probability of success to potentially make that profit. So not only does my stock, not only am I potentially risking less to make more, but how do I actually make that money? Well, my stock can go up, sideways, or even down a little bit depending on how I structured my trade. This is called skill. And this is called leveraging your money in a consistent way with skill. And once you have the skill, you can start to do this over and over and over again. This is called applying consistent action to then make those consistent results, to then start to just take care of maybe a bill or two every single month. And then from there, you can start to, as your skill grows and your proficiency develops, your level of proficiency grows and develops, then you can start to add or increase your contract size, your position size, where you really start to open some doors for yourself in your life, because now you're allowing your money, because of the skill that you're acquiring, you're now allowing your money to work for you. So that is very, very, very exciting. So with that said, we're going to go ahead and wrap up this session on a debit form of a cash spread. In the next session, we're actually going to take it even further, where instead of paying out money to do a spread trade, we're actually collecting money to do a spread trade. When you collect money to do a spread trade, you are actually doing what's called a credit spread. And many, many, many traders prefer actually to do a credit form of a cash spread, because then they're getting paid up front to enter the trade. So very, very, very exciting things to come in our next session. So we're going to go ahead and wrap this up. We'll see you in the next session. Thank you, everyone.